Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the 6th most popular investment trust on the AJ Bell Youinvest platform at the moment, namely BlackRock World Mining Trust. This closed-ended vehicle is run by Evie Hambro, a very experienced money manager whose career in the markets goes all the way back to 1994. He's responsible for 4 other open-ended funds as well for BlackRock: World Mining, World Gold, Gold and General, and International Gold and General, so spot the theme. However, we're here to talk about the World Mining Investment Trust, which has assets of just under £380 million. As its name suggests, the trust invests in quoted mining and natural resources companies on a global basis, with a mandate to maximise total returns for shareholders via capital gains and income. Hambro can also invest in the actual metals, unquoted firms, bonds, mining royalty streams and derivatives if he chooses, up to a maximum of 20% of the fund's assets. According to Morningstar, 4 of the investment trust's current top 5 holdings may be very familiar to you, as they all hail from the UK's Footsie 100, BHP Billiton, Rio Tinto, Fresnillo and Glencore. The exception is Russia's Norilsk Nickel. Overall, UK quoted stocks currently represent around 40% of assets, with Canada and then Latin America as the next biggest geographic areas, as this chart here shows. The portfolio is pretty concentrated, 56 stocks, and the top 10 represent more than half of the invested assets. To get access to Hambro's experience, expertise and trust, you have to pay an ongoing charge figure of 1.21% a year. Frankly, not too cheap, when the average investment trust costs 1.17%, but in the context of specialist resources plays, it is the lowest cost option in the field of 10 investment trusts and compares to a sector average of 1.65%. There's no performance fee. So those are the mechanics. The question to address now is, why are your fellow investors buying BlackRock World Mining Trust here and now? And for me, there are 4 possible explanations. First, it offers a dividend yield of 7.8%, and that's bound to catch the eye of income hunters, especially as the Bank of England is now hinting at cutting interest rates, not raising them. Though you will need to do your homework to make sure you think that figure is safe and reliable, just as Hambro will be doing for the individual stocks he owns. Second, the UK's June EU referendum could have a role to play. The Footsie 100's rallied strongly after the initial surprise caused by the Leave vote, and miners have been important here. They've very little, if any, direct exposure to the UK's economy and do benefit from the pound's plunge once their earnings are translated back into sterling, so they may be largely unaffected by the certainty on an underlying basis unless the British vote has wider global implications. This chart here shows how the Footsie all-share mining sector's done this year. Third, as you can see, gold and silver have surged as the markets have sought out a haven, and investors looking for some exposure may have latched onto this investment company as an option, especially as silver miner Fresnillo is a key holding. And finally, miners were just awful performers in 2015 and frankly for some time before them, and they dragged the BlackRock World Mining Trust down with them. Some investors may therefore be looking for a contrarian pick, especially as the investment trust's share price represents a near 14% discount to the net asset value, NAV, or actual value of the portfolio's holdings. If the sector returns to favour, the assets could rise and the discount close, giving a double whammy to performance. This chart shows the trust's performance over the last 5 years. There are risks. Global economic growth is still being crimped by huge debts, and deflation and recession remain a risk, neither of which would be good for mining shares. In addition, tough trading forced many miners to cut their dividends in 2015, so that fat yield can't be taken for granted. And finally, the investment trust does have borrowings as it's 13% geared. That can enhance returns on the way up, but make any downside moves worse. So again, you need to make sure this investment trust is suitable for your personal overall strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.